The money in your bank account feels real, but most of it doesn't physically exist.
If everyone demanded their money at once, the system would collapse in hours.
Once, money was physical, gold and silver, heavy, limited, real.
Goldsmiths promised gold, but people traded the promise instead. They issued more claims than gold. As long as no one noticed, it worked.
What began as a trick slowly became a system, accepted, trusted, and repeated. Governments realized banks could fund wars without raising immediate taxes.
Money was no longer metal. It was debt, a machine, recorded, promised, and owed.
One deposit becomes many loans. But only the first dollar ever existed.
Today, money is created with a keystroke, backed by nothing but your promise to repay.
To prevent collapse, central banks were created to guard confidence itself.
When banks run out of money, central banks step in, creating more.
Eventually, banks no longer needed reserves. Limits became symbolic. Today, banks are restrained not by cash, but by capital rules.
Banks don't lend deposits. Deposits are created by lending. As money multiplies faster than production, each unit buys less.
New money doesn't lift everyone equally. It flows to assets first.
Easy credit inflates bubbles that feel permanent, until they aren't.
When trust disappears, money disappears with it.
To save the system, more money is created, reinforcing the cycle.
This system doesn't just allow debt, it requires it.
If everyone paid their debts, the money supply would collapse.
Money has become information, weightless, instant, and fragile.
Understanding the system doesn't break it, but it changes your place within it.
Money itself is not wealth. Wealth is productive land, energy, skills, and assets that generate value over time. Inflation benefits those who own assets and debt, while wage earners often fall behind rising prices.
Financial crises occur when debt expands faster than incomes. The pattern has repeated for centuries.
Every individual operates inside this system, whether they understand it or not. Interest is the cost charged for using borrowed money. It requires repayment of more money than was originally created.
Because interest is not created with the loan, total debt in the system always exceeds the available money.
Since not all debt can be repaid at once, defaults are a normal and expected outcome of the system.
Refinancing delays repayment by extending debt, allowing borrowers and banks to continue operating.
Banks earn profit primarily through interest, fees, and the spread between borrowing and lending rates.
Because interest must be paid, the system depends on continuous economic growth to remain stable.
When banks reduce lending, new money creation slows across the economy. With less credit and spending, businesses reduce output, starting a recession. As revenues fall, businesses cut costs by reducing staff, increasing unemployment. Lower interest rates reduce borrowing costs, encouraging loans and spending.
Takes their move. Governments increase spending to support demand and employment during economic slowdowns.
Through quantitative easing, central banks buy assets to inject liquidity into the financial system.
Financial markets usually respond faster than wages or production to monetary stimulus.
While interventions stabilize markets, they often increase debt and financial imbalances over time.
When a currency weakens, imports become more expensive and domestic purchasing power declines.
Policymakers manage the balance between inflation, where prices rise, and deflation, where falling prices reduce spending and investment.
Central banks use communication to influence expectations and maintain confidence in the financial system. Policies in major economies affect capital flows, interest rates, and currencies worldwide.
Exchange rates move based on interest rates, capital flows, and trade conditions between countries.
When government spending exceeds tax revenue, the gap is financed by issuing debt.
Governments borrow by selling bonds to investors, promising regular interest payments and future repayment.
Bond yields reflect the interest rate governments must pay the borrower, influenced by inflation and risk expectations.
Central banks purchase government bonds to stabilize markets and lower borrowing costs.
Debt is considered sustainable when economic growth and revenues can support ongoing interest payments.
Public debt is backed by taxation and monetary authority, while private debt depends on income and cash flow.
Household debt allows consumption and home ownership, but requires stable income to remain manageable.
Companies use debt to expand operations, but higher leverage increases vulnerability during downturns.
Credit ratings estimate the likelihood of repayment and influence the interest rates borrowers must pay.
Default occurs when borrowers cannot meet payment obligations, triggering losses for lenders and investors.
Banks are regulated to limit excessive risk and protect the stability of the financial system.
Capital buffers are the bank's own funds used to absorb losses before depositors are affected.
Stress tests measure whether banks can withstand severe economic downturns.
Liquidity rules ensure banks can meet withdrawals and funding needs during stress periods.
Regulations aim to prevent problems at one institution from spreading across the entire system.
Shadow banking refers to credit creation by institutions that are not traditional banks and are less regulated.
Non-bank institutions manage and lend large amounts of capital without taking traditional deposits.
Derivatives are contracts whose value depends on underlying assets, interest rates, or prices.
Leverage allows investors to control large positions with borrowed money, increasing both gains and losses.
Risk can accumulate outside traditional banks, making financial crises harder to predict and contain.
Financial innovation creates new products intended to improve efficiency, returns, or risk management.
Securitization bundles loans together and converts them into securities that can be sold to investors.
Securitization transfers credit risk from lenders to investors willing to hold it.
Mortgage markets finance home purchases and are central to household debt and financial stability.
As financial systems grow more complex, risks become harder to identify and manage. When mortgage credit expands, housing demand rises faster than supply.
As competition increases, lending standards often weaken to maintain loan growth.
Instinct to crawler. When prices rise consistently, housing shifts from shelter to speculative asset.
Rising prices increase collateral values, enabling additional borrowing and reinforcing the cycle.
When borrowing costs rise or credit tightens, demand slows and the cycle reverses.
As demand falls, prices adjust downward and liquidity disappears.
When asset values fall below debt levels, repayment becomes impossible for many borrowers.
Curtains. After intervention, the system stabilizes and begins another expansion cycle.
Modern money is created through credit, sustained by debt, and stabilized by confidence.